Imagine selling the home where you raised your family, making a completely tax-free profit, moving peacefully into the next chapter of life, and then opening your mailbox months later to find a penalty from the CRA for thousands of dollars. Not because you cheated, not because you hid income, and not because you owed tax, but because you failed to file one form you may never have heard of. That is exactly the kind of financial shock hitting Canadian property owners in 2026, and seniors are especially vulnerable because many of these rules are technical, easy to miss, and buried behind assumptions that no longer protect you. If you own a home, a cottage, a rental property, or if you sold one recently, this is the information you cannot afford to ignore, because one missed declaration, one overlooked filing, or one title change made with good intentions can trigger penalties, audits, and tax consequences that can reach into the thousands or even the tens of thousands of dollars. Let me begin with Linda, a 71-year-old woman from Mississauga who sold the family home she had lived in for 34 years. She and her late husband raised 3 children there. Last autumn, she sold the property for $1,200,000, made a substantial profit, moved into a smaller condominium near her daughter, and believed everything was settled. The gain on the sale was fully sheltered by the Principal Residence Exemption. She owed no capital gains tax at all, but only a few weeks ago, she received a CRA reassessment carrying an $8,000 penalty. She was not penalized because tax was owing. She was penalized because the sale was never properly reported on her return. One form had been missed, and that one omission turned what should have been a routine tax-free transaction into a costly and deeply stressful problem. The disturbing part is that this rule has existed since 2016, and it is only one of several property declarations that can cost Canadians serious money in 2026 if they are ignored. This is not a small technical issue affecting only investors or wealthy families. In the last fiscal year alone, the CRA carried out nearly 15,000 real estate audits and recovered hundreds of millions of dollars in taxes and penalties. Property owners are being scrutinized more aggressively than before, and many seniors are being pulled into that system not because they did anything dishonest, but because they were never clearly told what paperwork had to be filed and when. What makes the situation more dangerous is that property compliance in Canada now operates on several levels at once. Federal rules apply, provincial rules apply, municipal rules apply. Each level can require its own declaration, its own deadline, and its own penalty. And the mistake many people make is assuming that if there is no tax owing, there is nothing to report. That assumption is no longer safe. The first major declaration every homeowner needs to understand is the Principal Residence Reporting requirement. Since the 2016 tax year, if you sell your home or if you are considered to have sold it through a deemed disposition, you must report that transaction on your income tax return. Specifically, the sale has to be disclosed on Schedule 3, and the principal residence designation normally requires Form T2091. The critical point is this: you must report the sale even if the entire gain is exempt and you owe absolutely no tax. Many people still believe that a tax-free principal residence sale does not need to be mentioned because there is nothing to pay. That is exactly the misunderstanding that creates penalties. If the sale is not reported, the CRA can challenge or even deny the exemption until the proper reporting is done, and there is also a late filing penalty that can reach the lesser of $8,000 or $100 for each complete month the form is late. Linda's case reflects that exact trap. She did everything right on the substance of the sale, but the reporting step was missed, and that single omission became expensive. Even worse, relying on an accountant is not always a complete defense. Courts have already shown little sympathy where taxpayers say the accountant should have known. The second major declaration involves municipal vacant home or vacant unit taxes, and these rules are catching homeowners by surprise because they apply even when the property is not actually vacant in any common-sense way. In Toronto, residential property owners are required to declare the occupancy status of their property every single year. The deadline matters, but the more important point is that you have to declare even if you live in the home full-time, even if you have owned it for decades, and even if nothing about your situation has changed. If you fail to submit the declaration, the city can deem the property vacant by default and impose a tax calculated as a percentage of the assessed value. On a home worth $700,000, that can mean tens of thousands of dollars, all because a declaration was never submitted. False declarations can also trigger additional fines. Hamilton has its own vacant unit tax system with its own deadline, its own grace period, and its own late fees. Ottawa has similar rules. British Columbia has a separate speculation and vacancy tax that applies in designated regions, and the rates in 2026 are even more severe for certain categories of owners. The dangerous misconception here is thinking that because one tax has been reduced, repealed, or changed somewhere else, all vacancy-related filing obligations have disappeared. That is simply not true. The rules depend on where the property is located and which government is involved. Missing one declaration does not produce a warning first and a penalty later. Often the penalty is what arrives first. To understand how serious this can become, consider a few real-world style scenarios. Picture a 69-year-old homeowner in Brampton who sold a property in 2025 for $950,000 after buying it decades earlier for a fraction of that amount. The gain is fully exempt because it was the principal residence the entire time. Tax owing should be zero, but if the seller fails to report the sale on Schedule 3 and does not file the designation form with the return, the exemption can be put at risk, and at a minimum, the late filing penalty can still apply. Now picture a 74-year-old snowbird with a Toronto home assessed at $800,000 who spends part of each year in Florida. That person may assume the property obviously remains their principal home and therefore nothing needs to be declared municipally. But the city still requires the annual occupancy declaration. Miss the filing, and the property can be deemed vacant, bringing a tax bill of $24,000. The problem is not that the person was ineligible. The problem is that the declaration was never made. Then there is the cottage problem, which is one of the most financially destructive mistakes families make. A retired couple owns a cottage purchased decades ago for $80,000 that is now worth $880,000. Someone suggests adding an adult child to the title to avoid probate fees later. It sounds simple, loving, and practical, but from a tax perspective, that transfer can trigger a deemed disposition. In other words, the CRA may treat part of the property as having been sold at fair market value the moment the child is added. That can create an immediate capital gain and a significant tax bill right now, all in an attempt to avoid a probate cost that may have been far smaller. On top of that, the child's future tax treatment becomes more complicated, especially if the child already owns another home and cannot shelter the cottage gain with the Principal Residence Exemption. One good intention can produce years of expensive consequences. What makes 2026 especially confusing is that one federal measure many people worried about, the Underused Housing Tax, has effectively been eliminated going forward, and that has led some owners to believe the broader compliance pressure around property has disappeared as well. It has not. The end of the federal Underused Housing Tax for future years does not cancel municipal vacant home declarations, provincial vacancy taxes, principal residence reporting rules, anti-flipping rules, or change of use rules. It also does not erase obligations that may still exist for past years where filings were required. That distinction is critical. Just because one tax has been removed does not mean all property reporting obligations are gone. In fact, for many seniors and homeowners, the most dangerous period is precisely when a rule change creates false confidence. Another important rule, and one that can actually help seniors, is the +1 rule within the Principal Residence Exemption formula. When you sell one home and buy another in the same year, the exemption formula includes an additional year that can help cover the overlap. This matters tremendously for downsizing seniors who sell a long-time family home and purchase a smaller residence in the same taxation year. Many people do not know this rule exists, yet it can preserve the full exemption in situations where a transition year might otherwise create concern. There is also a broader point many Canadians misunderstand. A cottage can sometimes be designated as your principal residence. The law does not require your principal residence to be the house in the city where you spent most of your time. If a cottage was ordinarily inhabited during the year and was not primarily held to generate rental income, it may qualify. That means families with both a city home and a cottage should not automatically assume the city home must receive the designation. In some cases, the smarter tax result comes from designating the property with the larger accrued gain, but that decision should be made carefully and with full awareness of the numbers involved. Let me now walk through the 5 most common and costly property mistakes seniors make, because understanding these errors can save far more money than most people realize. The first mistake is selling a principal residence and not reporting the sale because it was tax-free. This remains one of the biggest traps. A tax-free result does not erase the reporting obligation. The second mistake is ignoring municipal vacancy declarations. Because you live in the home, spend most of the year there, or assume the city already knows the property is occupied. The city may know a great deal, but it still expects the owner to submit the declaration. The third mistake, and often the most expensive, is adding an adult child to the title of a cottage, rental property, or other non-principal residence asset in an attempt to avoid probate or simplify inheritance. The tax consequences can be immediate, the legal consequences can be messy, and the expected probate savings may be small by comparison. The fourth mistake is selling a property within 12 months and failing to consider the anti-flipping rule. Since January 2023, gains on certain residential properties sold within 365 days can be treated as fully taxable business income rather than capital gains, which means the principal residence exemption may not apply. There are life event exceptions, such as death, illness, relationship breakdown, or certain relocations, but those exceptions must be properly understood and documented. The fifth mistake is converting a home to a rental and not addressing the change of use rules. Many seniors downsize, move into a condo or retirement residence, and rent out the old home for a period. That can trigger a deemed disposition unless an election is filed. If the proper election is made, the property may continue to qualify as a principal residence for up to 4 additional years, provided certain conditions are met, including not claiming capital cost allowance. Miss that step, and valuable tax protection can be lost. So what should homeowners and seniors do right now? First, if you sold a property in 2025, review your 2025 return before filing, or amend it if necessary to make sure the sale is properly reported on Schedule 3 and that the principal residence designation has been handled where required. Do not assume this was done. Ask directly. Second, if you own property in a city or region with a vacant home, vacant unit, or speculation tax regime, submit the required declaration immediately or confirm that it has already been submitted. Do not rely on memory. Do not rely on assumptions. Verify it. Third, if you have ever added a child or another relative to the title of a cottage, rental property, or second home, get professional advice on whether a deemed disposition may already have occurred and whether any corrective planning is available. Fourth, if you converted a former home into a rental property, confirm whether the change of use election was filed and whether capital cost allowance was ever claimed. Fifth, keep an eye on bare trust reporting developments because arrangements where a child is on title, but the parent remains the true beneficial owner may create filing obligations as these rules continue to evolve. Sixth, log into CRA My Account and review all notices, correspondence, and account information related to real estate matters. Many problems become far easier to fix when they are caught early. The lesson in all of this is not that property ownership has become impossible. The lesson is that paperwork now matters just as much as the transaction itself. Seniors who spent decades building equity can lose thousands of dollars, not because the tax law was fundamentally unfair, but because the filing system is increasingly technical and unforgiving. Linda's story proves that point perfectly. She did not owe tax on the sale of her longtime home, yet she still ended up facing a painful penalty because one required designation was not filed on time. She was eventually able to seek help, file late, and ask for relief. But not everyone is as fortunate, and even when relief is granted, the process is stressful, slow, and uncertain. The CRA is active. Municipal vacancy taxes are active. Provincial declarations are active. Anti-flipping rules are active. Change of use rules are active. Bare trust reporting is becoming more important. If you sell, own, transfer, rent, or restructure property, there is almost certainly a form, a filing, a deadline, or a disclosure requirement attached to that event. And if you miss it, the system will not care whether you were a full-time investor or a retired grandmother who simply assumed nobody needed to know about a tax-free sale. That is why awareness matters so much. After 30, 40, or 50 years of working, saving, and building a home or cottage, no one should lose thousands of dollars over a declaration they never knew existed. Protecting yourself starts with asking the right questions before a deadline passes, before a title change is made, and before an assumption turns into a reassessment. If there is one takeaway to remember, let it be this. When it comes to property in Canada in 2026, never assume that no tax means no paperwork. Sometimes the paperwork is the entire issue. There is also a hidden psychological problem in these cases that deserves attention. Many seniors delay asking questions because they feel embarrassed about not understanding the forms. Or they assume that if something important were required, someone from the government, the lawyer, the bank, or the accountant would automatically tell them. Unfortunately, that is not always how the system works. Real estate transactions often involve different professionals handling different pieces of the puzzle. A real estate lawyer may close the sale correctly, but not prepare your tax return. An accountant may prepare the return, but not know about a title change that happened years earlier. A financial advisor may suggest a probate saving idea without fully explaining the tax result. Municipal vacancy declarations may arrive through mail or email and get ignored because they look routine. No single person may be looking at the whole picture unless you force the conversation yourself. That is why the smartest approach in 2026 is to treat every major property event as a compliance event, not just a money event. If you sell, ask what has to be reported. If you transfer, ask whether there is a deemed disposition. If you rent out a former home, ask whether a change of use election is needed. If you own property in a city with vacancy rules, ask what declaration must be filed and by what date. If you put a child on title, ask whether you have created tax, trust, or probate consequences you did not intend. If you inherit property and then sell it quickly, ask whether the anti-flipping rule could apply or whether a life event exception needs to be documented. Those questions can feel repetitive, but they are far cheaper than a reassessment. It is also wise to build a simple property file for yourself. Keep the purchase documents, sale documents, renovation records, legal letters, title changes, assessments, tax returns, municipal declarations, and any correspondence from the CRA or the city in one place. Many people do not realize how important records become until years later, when they need to prove cost, occupancy, ownership, or intention. Even something as ordinary as receipts for major improvements can matter when calculating capital gains on a cottage or rental property. Good records do not just help in an audit. They help you make better decisions before one ever starts. If you are helping an aging parent, this matters even more. Adult children often step in only after a letter arrives, a deadline has passed, or a penalty has already been assessed. By then, the conversation is harder, emotions are higher, and the available options may be narrower. A far better time to review these matters is while everything still looks calm. Sit down together. Make a list of all real estate owned now or sold recently. Confirm who is on title. Confirm which property was a principal residence and for which years. Confirm whether any property sits in a city with a vacancy declaration requirement. Confirm whether any former home is now rented. Confirm whether any trust-style arrangement exists, formal or informal. These are not small details anymore. They are financial pressure points. And one final reminder. Deadlines do not become less real because the rule feels unfair, obscure, or poorly advertised. The government does not measure penalties by how understandable the paperwork was. It measures them by whether the paperwork was filed. That is why delay is so expensive. If something in your situation sounds even remotely similar to what I have described, do not wait for absolute certainty before taking action. Review the file, call the city, contact your accountant, speak to a tax professional, and get clarity while a fix is still easier, cheaper, and more likely to succeed. One missed form can wipe out years of careful planning, So verify your filings, declarations, title changes, and elections now, while corrections are still simpler, faster, cheaper, and far more likely to succeed. Canada Pension Vault.